Good morning and a very warm welcome to all of you for being here with us today on a first 2024 Sunday morning for the PMI PWL event. My name is Dr. Meenal and I'm your host for the day. On behalf of PMI Pune Deccan India chapter, I would like to thank all of you who have been with us since the time we began our journey, as well as those who have recently joined us. We are here today to hear from our credible and knowledgeable speaker, Ms. Aarti Atal, who would enlighten us on financial empowerment. I'm sure that this session would help us to build a strong financial foundation, empower us to take control of our finances, and make informed decisions for a secure financial future. But before we proceed ahead to the agenda, I would, on behalf of PMI Pune Deccan India chapter and PMI Pune Women's League, wish you a very bright and prosperous new year. It's my privilege to welcome our speaker, Aarti Atal, for today's event. Aarti is a highly qualified professional in the field of finance, particularly focused on individual personal finance. She has a background as a chartered accountant and a chartered financial goal planner, and she has extensive experience in income tax return filings, investment advisory, and channeling of mutual funds in India. Aarti's expertise extends to handling a large number of individual clients annually, ranging from freshers to senior directors. And she has specialized knowledge in taxation for foreign shares, capital gains from the sale of apartments, mutual fund investments, and many more. Now, I would hand over to Aarti.
Sorry, that feature isn't available. Use your device.
Hi, all. Greetings for the day. Thank you for joining me. I hope I'm audible.
Yes, Aarti.
Okay. Dear all, greetings for the day. Thank you for joining me on this Sunday morning for the next 45 minutes. I'm humbled and honored to be invited by Project Management Institute Pune Deccan India chapter to to give me an opportunity to share my knowledge on taxation and personal finance to the esteemed people present here. Female participation in financial decision making and proper tax planning will empower more to the traction in financial well-being. Along with our career knowledges in various fields, the knowledge of finance and taxation enables us to participate more actively in important financial decisions of our life and take informed decisions at every stage of our life, whether it is at the stage of capital accumulation or the capital distribution. In this today's session, I plan to cover the below topics. Taxation planning, goal-based investments, and asset allocation. We'll start with our first topic, which is taxation planning. Under taxation planning, I plan to cover those topics which are more relevant for salaried professionals and in our day-to-day every year's tax filings. As we enter into the last quarter of financial year 23-24, it's high time to get our taxes together and our financial details together in line to plan our taxation for FY 23-24. When we speak about taxation, the first and foremost question that comes into our mind since last couple of years is which tax regime should I opt for, the old one or the new one? Let me throw some light on the changes that we have seen in past 3 years. Budget 2020 introduced a new personal income tax regime that has more tax slabs but lower tax rates and lower compliances with regards to the deductions exemptions which are applicable in older tax regime. That would mean that it plans to simplify the tax filing process or the tax planning process. And eventually, I believe that the government or the finance ministry wants everybody to move to the new tax regime over some years, like we are in a transition phase. But currently, we have an option to choose either old tax regime or new tax regime. As we are aware that income tax in India has to be paid on the net total income, which is addition of all the incomes we have earned during the year, less the deductions, exemptions applicable in the respective under the respective incomes. So when we talk about tax slabs, under the old tax regime, the tax slabs, there are four tax slabs. Up to income up to 2,50,000, there is no tax. For the next 2,50,000, that is 2 to 2.5 to 5 lakhs, the tax rate is 5%. From 5 to 10 lakhs, tax rate is 20%, and above 10 lakhs, it is 30%. So it would mean that if someone is having income above 10 lakh, then the tax amount on the total income on the total income would be 1,12,500, that is calculation up to 10 lakhs, plus 30% on the income which is exceeding 10 lakhs. However, under old tax regime, there are more deductions, more exemptions applicable, which are not applicable under the new tax regime. We'll see it in the next slide. Under the new tax regime, they have different slabs for every additional 3 lakhs. So income up to 3 lakhs, there is no tax. For income for the next 3 lakhs, the tax rate is 5%, and income from 6 lakhs to 9 lakhs, tax rate is 10%. Income from 9 to 12 lakhs, tax rate is 15%, 12 to 15 is 20%, and income above 15 lakhs is 30%. So if I have to say precisely, someone is having income above 15 lakhs, tax payable would be 1,50,000, 1,50,000 plus 30% on income above 15 lakhs. So how do we judge whether should we opt for old tax regime or new tax regime? There's a very small calculation which says if the total income of any assessee is above 15 lakhs, and if you have a total deductions which are exclusively applicable only in old tax regime, that is those deductions are not available in the new tax regime, are at least 3.75 lakhs, then old tax regime would be beneficial. Else, new tax regime would be beneficial. Beneficial in the sense the effective tax amount which is payable would be lesser in the new tax regime. Now the question is, one more question which we often see is under the like most of the salaried professionals, they have declared either old tax regime or new tax regime to the employer. But at the time of tax filings, they realize that, vice versa would have been more beneficial for us. If you do not have income from business or profession, you can always change the tax regime at the time of filing of tax returns, like even if you have opted for other scheme with your employer. So that is not an issue. For some, the questions is in FY 22-23, like last year I opted for new regime, but this year I have taken a home loan, so I want to opt for old regime. Can I change? Yes, you can change it at the time of filing tax returns. Next, we'll discuss those items which are either allowed under both regimes or allowed specifically under old tax regime only. The first is for all salaried professionals, there is a standard deduction applicable up to rupees 50,000, irrespective of your income range, whether it is 10 lakhs, 50 lakhs, or whatsoever. Till FY 22-23, it was allowed only under new tax regime, but not under it was allowed only under old tax regime, but not under new tax regime. But from current financial year, that is FY 23-24, it is allowed under both tax regime. So standard deduction will not be a point to think which regime would be beneficial because it is allowed under both regimes. Then professional tax of 2,500, the 200 rupee deduction that we see in our payslips every month, it is allowed under old tax regime but not under new tax regime. Third comes house rent allowance. Now house rent allowance as an exemption is applicable if you are staying on a rented property at the city of work. Like if my workplace is Pune and I'm staying at my parents' place at Bangalore, which is a rented apartment, I will not be able to claim the house rent allowance. So I must stay in that city which is my workplace. Then HRA exemptions is also dependent upon whether we are staying in a metro city or non-metro city. How much is the basic pay? So it depends not only upon the rent which is paid every month. Like I cannot say if my rent paid is 20,000 per month, my HRA exemption will be 2,40,000 per annum. No. The calculation for this depends upon whether we are in a metro or non-metro. What is our basic salary, like the salary component which the employer gives, out of that what is the basic salary component, depending upon that we calculate the HRA exemption. It is allowed under old tax regime, but not under new tax regime. The next set of allowance is leave travel allowance. Two travels in the block of 4 years. This time the block started from 1st January. Usually our financial year is April to March. But for LTA, the block starts from January to December. So for 4 years, calendar years, like starting from 1st January 2022, now we have time till 31st December 2025. These 4 years comes under one block. In this one block, you can claim LTA exemption twice. To claim the LT exemption, the travel has to be done within India. We cannot claim LT exemption if we are traveling outside India. Second thing is to claim LT exemption, we must be on personal leave. Like, our attendance with the employer must be marked as PL on the dates of travel. Third is only travel expenditure is covered, like flight tickets, but then boarding passes are mandatory. Train tickets, taxi fares are allowed. We cannot claim hotel expenditure or local conveyance or food expenditure under LTA. HRA and LTA, in case you have missed to claim the same with employer before the proof submission dates, we can always claim it at the time of filing tax return. The next exemption is a meal card exemption or meal allowance. Earlier, we used to have Sodexo coupons, physical coupons, which are now disallowed which are now not permitted by RBI. So we have meal cards, type of debit cards wherein the amount is being credited every month. 2500 per month. It is allowed under old tax regime and not under new tax regime. Then at the time of before we begin every financial year, most of the employers give an option of flexi basket allowance. Flexi basket allowance is, it gives you an option to choose amongst the various options available, which can be claimed as reimbursements. Reimbursements would mean that they would allow some exemptions, but you can claim them only if you submit the proofs. It can be like car fuel, maintenance, chauffeur charges, mobile expenditure, internet charges, books, professional allowance, etc. Here, the most important point is they give you an allowance by a specific name. Let's say they are saying car fuel allowance of 21,600. During the year, if you are submitting proofs worth rupees 21,600, the entire 21,600 will be credited in your bank account without any tax. That is, the entire reimbursement becomes tax free. If you are submitting only proportionate bills, suppose you have submitted only 10,000 or 12,000, that amount will be tax free, remaining would be taxable, and then amount will be credited. The most important point here is, with regard to these reimbursement, they must be claimed through employer only. We cannot claim the same at the time of filing tax returns. It is not allowed. So to claim the car fuel, maintenance, mobile internet, ensure that under your claim reimbursements, you put a claim before February or March, as every employer may have. So these are the things which are allowed under old tax regime, but not under new tax regime. Next, and we'll just move to the next topic, which is capital gains. Capital gains is any capital assets. If we are selling them and the gains arising from any capital assets will be treated under the head capital gains. Capital gains is a very wide topic and it has so many things in it, but I'll try to cover the ones which are, mostly applicable in individual cases. Now, when we say sale of capital asset, capital asset can be your sale of land, maybe agricultural land or non-agricultural land, sale of buildings, that is most likely apartments, row houses, vehicles, and then shares, mutual funds, foreign stocks, etc. The taxability of capital gain is very peculiar. Like the period of holding of asset is very important to determine what would be the tax rate, how it will be taxed. So as you know, we are more into financial markets now, and almost everybody have their investments either in stocks, mutual funds, foreign stocks, and all those. I'll try to cover capital gains specifically related to these topics. Now, capital gains related to Indian equities. First, we'll look into Indian market, like Indian capital market, I will say. Indian capital markets are divided into two parts. Like one is the equity portion and other is the debt portion. So first topic is listed equity shares in India. The listed equity shares in India means the stocks which we usually buy through our brokers, maybe Zerodha, ICC, or Motilal Oswal, whatever. In case if the shares are held in a demat, or if the period of holding is less than 12 months, then any gains on the sale of shares will be taxed at flat 15%. That is, although we may be in 30% tax bracket, but if we are holding the shares for less than 12 months, it will be taxed at 15% flat rate. Of course, surcharge and education cess as applicable will be charged. If the period of holding is about 12 months, then the tax rate would be 10%. Suppose I got TCS for 2000 rupees 5 years back, and today I'm selling it at 3500. So the net gain of 1500 will be taxed at 10%. The point here to note is till 2018, long-term capital gain on equity were exempt from tax. Like there was no tax on long-term capital gain on equity. Then government introduced this new tax of 10% on long-term capital gains. But then they also gave an exemption, like for small depositors, for small shareholders, for small retail individual investors. They said that okay, up to 1 lakh rupee gain per year, there won't be any long-term capital gain. So if at all I'm selling my listed equity shares in India and having a gain of 1,50,000, the 1 lakh gain would be exempt for that year, and 10% will be applicable only on the additional 50,000. This 1 lakh exemption is applicable every year. So in case you don't plan to sell any shares, but still you are having unrealized gains, you can ensure that you are selling shares and booking profits up to 1 lakh tax free, and then you can again buy those shares for the same. The same tax rates are applicable for equity mutual funds also. Equity mutual funds are those mutual funds which invest at least 65% of the total AUM under in equity stocks. Like they may have some cash component, they may have some gold in them, or they may have debt component in them, but within equity, they should invest at least 65% of AUM. Generally speaking, all these large cap funds, mid cap funds, small cap funds, multi cap funds, arbitrage funds, or aggressive hybrid funds comes under equity mutual funds. So the tax rate here would be for long term capital gain 10% over and above 1 lakh. Up to 1 lakh, it is exempt. And for short term capital gain, that is the period of holding is less than 12 months, it will be taxed at 15%. The next category, which has come into existence only from this financial year, is specified mutual funds. Specified mutual funds are like debt funds, conservative hybrid. Till last financial year, debt funds were taxed at long-term capital gains on debt funds were taxed at 20% plus slab rate. So we had always recommended debt funds over the fixed deposits, because fixed deposit interest is taxed at your tax slab rate, whereas debt funds used to give you tax only at 20%. But from current financial year, debt funds in debt funds there is no short term or long term. Like it does not depend whether your period of holding is 1 year, 2 years, 5 years, 10 years. Whenever you are redeeming them, it will always be taxed at your slab rate. Because if I have no income, then it will be taxed at 0%. If my income is at 30, taxed at 30%, it will be taxed at my slab rate. That is the highest slab rate. Under these specified mutual funds, those mutual funds which invest in other mutual funds. See, under equity mutual funds in directly buy the stocks from the market and hold them. Fund of funds invest in another mutual funds. So in case you are investing in fund of funds, then the tax rate would be at slab rate. And then there are gold ETFs, liquid ETF, like those are in invest in liquid Bs and all. And then conservative hybrid funds. Conservative hybrid funds are those funds wherein the equity portion is maximum up to 25%. Like they don't hold more than 25%. And the debt portion is 75 to 90. So mostly they are more inclined towards debt. That is also taxed at slab rate. Then debt mutual funds are those funds which invest in debt securities, money market, government securities, corporate bonds, commercial papers, and all those things. Then there is one category of mutual funds which invest in equity as well as debt, but the investment portion of equity is more than 35% but less than 65%. Suppose the fund has to invest 100 rupees. It is investing in equity sometime somewhere between 35 to 65 rupees. So those funds are, if it is short term, taxed at slab rate. If it is long term, taxed at 20% with indexation. Here, point to be noted is, here the short term capital gain, that is the asset is treated as short term if the period of holding is minimum 3 years. If the period of holding is above 3 years, then it is treated as long-term capital gain. Whereas we have seen that under listed equity shares or equity mutual fund, the period of holding for short-term capital gain was 12 months, that is 1 year. But under balanced hybrid funds, the period of holding to consider short-term capital gain is 3 years. So you have to hold minimum 3 years if you want to get a lower tax rate, which is 20% with indexation. This covers most of those equity funds, debt funds, and mutual funds and stocks. The next topic for discussion would be taxation on foreign stocks. Now, taxation on foreign stocks, usually tax foreign stocks are purchased two ways. One is most of the Indian corporates which have their parent company outside India, like those companies which are in India, which are fully owned subsidiary of a company which is outside India, may be listed or not listed, most of the times listed. They have started giving shares to their employees as a retention policy, as an appreciation, or as a bonus in forms of RSUs, ESOP, ESPP, etc. And with the advent of the technology, right from India also we can invest directly into foreign stocks using through our brokers. Whenever we are buying or holding foreign stocks, either it is through our employer, ESOP, RSU, ESPP, etc., or through own buying, the compliances are totally different than what we have been holding shares which are listed in equity, listed in India. So those stocks which are not listed in India, that is, which are listed outside India, as soon as the shares are granted to you or the shares are vested in your name, like in case of RSUs, first the shares are vested and then the shares are so first the shares are granted and then they are vested. There are two different disclosures. One is disclosure of foreign assets. Now, Indian Finance Ministry wants everybody to disclose all the foreign assets, whether it is the land or building purchased in foreign country or here as we are discussing shares. In which country you are holding the shares, who is the foreign broker through whom you are holding the shares, what has been the investment value, whether you have done any redemptions or received any income out of it. So in case of RSUs or ESOPs, as soon as the shares are vested, it is taxed as perquisites in your Form 16. So, in that case, what happens? Suppose the company has given 100 shares to you as RSUs, and they calculate tax on it and immediately sell off 33 shares, and remaining 66 shares are vested in are credited in your broker account. Although you don't have to pay any additional taxes when the RSUs are vested, because it is taken care by the employer, because that is taken care by the employer and is taxed as perquisites in Form 16. But the reporting and the disclosure under foreign asset stamps in tax return is mandatory. It is mandatory, and the non-compliances results in penalty. Now, second thing is, once the RSUs, ESOPs are vested, they are being received in your, in your broker account, and you continue to hold them. You're not selling them immediately. You continue to hold them for a few years. Every year, dividends are being received. Now, these dividends are taxable in India because we are filing tax returns in India as resident Indian. For taxation as resident Indian, global income in India is taxed. Like for resident Indians, any income which we are earning across the globe is taxed in India. However, whenever the dividends are received in any foreign countries, they in the foreign country also they may withhold some portion of taxes and then pay you after the taxes. That would mean, suppose I'm holding shares which are listed in US and I receive dividends of $1,000. So they are already withholding $250 as tax. And when I'm saying that I have to pay tax on it in India, I'll convert it into INR. And that does not mean that I have to pay tax entirely on $1,000 at 33%, which is my tax slab. It means that whatever tax I have already paid in a foreign country when I receive the dividends, like foreign country, whenever they are withholding any taxes, I can always claim a credit for the same. So it does not mean that I will be double taxed. This is called as TTAA, Double Taxation Avoidance Agreement, which India has with various countries. So the tax will be deducted in foreign country, but at the time of filing tax returns, we cannot say that already tax has been deducted in final in foreign country. So we are not, we are not inclined to pay any taxes in India. No, we must declare those dividend income in India, calculate the tax as applicable in India, then take a foreign tax credit of the taxes which are paid outside India. For this, along with the tax return, we need to file a special form which is called as Form 67 to claim the foreign tax credit. This is the taxation on dividend. Now, at the time of sale of shares, when the RSUs were received by you, they were taxed as perquisites. At the time of sale of shares, if the sale value is more than the vested value, like RSUs were vested when the shares were at $100 per share, but today the market value is $200. So the when the RSUs were vested, the perquisites which were taxed in your Form 16 becomes the cost of purchase. And when we are saying taxation at the time of sale of shares, we just have to calculate the gains on shares. I received shares at $100. I'm selling them at $200. So now I have to calculate tax on the gains, which is $100. 200 minus 100. Now taxation of sale of foreign shares. In case of equity shares or mutual funds which were listed in India, we have seen long term, short term. Similarly, for foreign shares also there is long term and short term. Short term is when the period of holding is less than 2 years. Long term is when the period of holding is more than 2 years. So short term capital gain on foreign stocks will be taxed at your slab rate. Like if you're into highest tax bracket, 30%, it will be taxed at 30%. And for long term capital gains, like if you are holding the foreign stocks for more than 2 years, like from the day you purchased or from the day they are vested till the date of sale, if it is more than 2 years, it will be taxed at only 20% and indexation benefit. Indexation is nothing but inflation adjusted price. Like if I bought something for 100 rupees 5 years back, I cannot say that the cost is 100 in today's parlance. It must have increased as per inflation. So there is a separate set of calculations which department has. One more point I just want to point here in terms of capital gains for equity shares and mutual funds. Many of you who must be in that investment banking, jobs, most of the corporates they disallow or they do not disallow, they do not permit you buying the close-ended mutual funds. So all these mutual funds, whether equity, debt, or something, anything, they are treated as open-ended and close-ended. Open-ended mutual funds are those mutual funds once which they are launched, you can purchase anytime, anywhere. Like all the equity mutual funds are open-ended mutual funds. They're not closed-ended mutual funds. Usually closed-ended mutual funds are those mutual funds which have a lock-in. Only the fixed maturity plans comes under closed-ended mutual funds. Like as whenever they are launching that MF, they say that the period of holding is 3 years or the period of holding is 2 years, and accordingly they buy those debt papers which are matching the time of maturity. So mostly only debt funds, under debt funds these are called as FMPs, only that comes under closed ended mutual funds. Rest all the mutual funds, even if it is like your liquid funds, money market funds, government securities, all those comes under open ended mutual funds only. So some of the corporates they have restrictions for purchase of closed ended mutual funds, like they allow purchasing of only open-ended mutual funds. So here we discussed on capital gains on equity shares in India, equity mutual funds, debt mutual funds, specified mutual funds, and then taxation on foreign stocks. We'll go to the next session. Once we add income from all the sources, like we added our income from salaries, considering whether we need to consider old regime or all or new regime. Then we'll add income from the head house property, which will include your rental income if any property is let out or if multiple properties are let out. So rental income means any income from any property. It can be your residential or your commercial. Then we'll add your capital gains and other income from other sources, which we'll discuss later. And from all the incomes, there are again certain deductions which are allowed under old regime but not under new regime. So this will also matter whether you should opt for old regime or you should opt for new regime. First deduction is ATC. Like ATC, maximum limit of ATC is 1,50,000. Under ATC, we can do investments under our EPF, like the 12% of employee provident fund, which gets deducted from our pay slips every month. Then public provident fund, PPF, in the name of self, spouse. Then in case there is any home loan, the home loan's principal component. Whenever we are paying EMI of an home loan, it has two components, interest and principal. So only the principal component can be covered under ATC. Then ELSS mutual funds which have a specific category of ELSS, that is they have 3 years lock-in which can be allowed under deduction of ATC. This is allowed under old regime but not under new regime. Next is NPS. I'll just take a couple of minutes to throw light on NPS, which is National Pension Scheme was once introduced in 2004, and it was earlier for only central government employees, and now it has been extended to uh, private employees and all. Any individual who is between 18 to 60 can join NPS. Now, only you have to remember that contributions have to be made under tier one only for to claim the exemption under National Pension Scheme. Contributions to national pension scheme can be done in two ways. First is through the employer. Like most of the corporates now they have tie up with NPS and they keep us reminding that in case you want to opt for NPS, please do opt. So maximum deduction is basic salary ka 10%. 10% of the basic salary, like how EPF is deducted and deposited with the EPF form. Similarly, NPS is deducted from your basic salary and that is from your gross salary and deposited with the NPS CRA. So employer contribute up to 10% of basic and deposited. This is allowed as deduction under both regimes. Like tomorrow, if at all there is no old tax regime, say down the line 3 years, 4 years, we have come out of the transition and we don't have old tax regime, there is only one tax regime. Still, the government's intent is always to have the pension scheme alive, and hence it is allowed as deduction under both the tax regime. The reason is they eventually, for at least for government employees, they want to come out of the old pension scheme because it is a huge burden on the country's GDP and all. So so this is allowed under allowed under both tax regime, and it acts as you can mark it against your retirement planning, because the period of holding for NPS would be 60 years. Like you need to hold the NPS account at least till the time you turn 60. And then once you turn 60 years, 60% of the NPS corpus can be withdrawn by you and utilized as you would wish. May be withdrawn. You may or may not, but it can be withdrawn. But for the balance 40%, you have to buy mandatorily annuity. Annuity in the sense you have to buy either monthly pension for self or till the life of self or till the life of self or spouse, depending upon the plans which are applicable at that point of time. So that means you are contributing from the time you are joining the job till the time you're getting retired, and it will help you to generate regular income upon your retirement. So employer contribution up to 10% of salary is allowed under both the tax regime. Employees contribution, that is on your own also, you can invest in tier 1 and claim additional exemption. Maximum exemption allowed is only 50,000, but this is allowed under old tax regime and not under new tax regime. So you can claim both these deduction. These are exclusive to each other. Suppose my basic pay is 10 lakh rupees per annum, I can deposit 1 lakh through my employer and also 50,000 on my own and claim an exemption of both 1 lakh 50,000 in old tax regime, but under new tax regime only the 10% is allowed. Next set of deduction is the health insurance premium paid for self and family, which is maximum up to 25,000 if my age is below 60 years. For senior citizen parents, if we are having their health insurance premium, we can claim maximum deduction up to 50,000. In case senior citizen parents do not have any health insurance premium, and if we are incurring any medical expenditure on them in that year, in a financial year, then also we can claim an exemption of 50,000. So for senior citizen parents, those who have insurance can claim exemption up to insurance premium. Those who do not have any insurance can claim the expenditure for medical expenditure up to 50,000. Then there is a small deduction of 5,000 as well for preventive health checkup. In case we are going for a full body checkup or so, we can claim a deduction of 5,000 rupees. Then interest on savings account. All are bank accounts unless they are current accounts. For salaried, most of the bank accounts are saving accounts. Interest is credited every quarter. Like we'll get 4 interest credits in a year. Income up to interest on savings account up to 10,000 is allowed under old tax regime, but not under new tax regime. Now we'll come to the next topic, which is what is the income which needs to report under ITR. We discussed about salaries, we discussed about capital gains, we discussed about disclosures. I also told you about the rental income that will be taxable. But apart from all these, there are certain other incomes which are also to be reported under ITR. Incomes which are earned like interest on interest on savings account, interest on fixed deposits, then dividends on Indian stocks or dividends on mutual funds. Then we have certain other incomes like brokerages or commissions received from any affiliations or so, any honorarium which have been received in the year. All these incomes are taxable. Sometimes some incomes are not taxable but are exempt in the sense they are not taxable, like the ppf interest. Everybody knows that the ppf interest is exempt, it is not taxable, but a reporting can be done for the same while filing the tax returns. Whenever we are filing tax returns, we have to ensure that we are looking into the important documents that department has. Like now department has started collating data on its end from various external sources. So 26 years is a form which reflects if there is any TDS which is deducted. Like if the TDS from your employer, TDS from your banks while paying fixed deposit interest or while crediting fixed deposit interest. Here, one more important point is income for the year is taxable on all the income. Suppose I've shifted job, like I started with company X in April, I was with them, and in October I shifted with company Y. I have to ensure that both my employer's income is added and tax is payable on that. So whenever I'm joining new employer, I have to ensure that I'm reporting my old employer's income to my new employer so that they deduct a appropriate tax. It is better to study on this or get a professional advice, because lesser deduction of tax would mean you have to pay the tax on your own. Mean you have to pay tax on your own. So that would mean that if you are realizing it at the time of filing tax returns, you may have to pay the interest and penalty on it. Along with 26 years, since 3 years, department has also come up with the two different forms, which is annual information AIS and TIS. It discloses all the details, like what are the dividends you have earned during the year, what are the interests you have earned during the year from savings account, from fixed deposits, how which mutual funds did you sell, which shares did you sell, what was the cost of buying. So they every day there is a new development. Every day there is a new development in this AIS and TIS. So at the time of filing tax returns, we have to ensure that we are looking into these statements, and our tax filing should be in compliances and matching with these. In case there is any discrepancy, we just need to report the same. Now, once we file the tax returns are processed by the department, that is CPC Bangalore. And then they send us the intimation. You must have seen in your mailbox, like you have no refund, or the tax return is processed, there is no refund due. The tax return is processed, there is a demand. So we need to open the 143(1) intimation and just see. It gives you a comparison between the tax return we have filed and what the department has considered. If both of them are same, then there is nothing to worry. If there is any changes or something like that, then we have to look into the matter and file revised return or updated return or so. If there is any old outstanding like 2010, 11, 9, 10, there were some taxes which were due, and today you're claiming any refund for current financial year, department has a right that it will not give you the refund for the current year, but will adjust this refund with the old outstanding demand. In that case, they send you a communication under 245. So all these things needs to be taken care at the time of tax filings and also after tax filings. Now, once you have come to an end of our taxation, I'll just go through goal-based investing. Whenever we are investing means savings and putting the money into various baskets, various asset baskets. The asset baskets can be real estate, asset basket can be gold, asset basket can be equity and debt. Majorly, there are only four asset baskets that we have across. We need to put our investments in that asset basket depending upon when do we have to use the funds. So first you have to define when do you need the money, and then you have to strategize how we should wherein you should put the money, uh, because the most important part of goal based investment is money should be available at the time of need. If I have money but I don't have it when I need it, then there is no use of this money. So there we have to always see, there are some goals which can be deferred. Like I want to go to a foreign vacation after 2 years. If at all I'm not able to match up my investments with the amount that I need for foreign vacation, I can always defer it to another year, another year. But there are some goals which cannot be deferred, like the amount which I assume may be needed when my daughter goes into her graduation. I know today she is in class 9, I need that money after 3 years. I cannot defer that, oh, markets are down, so I'll hold for one more year and then sell. It cannot be done. So some goals can be deferred, some can be timeline. Investments are to be based on timelines and risk level. If we are basing our investments and investing it in such a manner that for long term goals going more on equity, going more on other assets, and for short term goals keeping more liquid assets, keeping our amount in fixed deposits or debt mutual funds, or where it can be easily withdrawn and not related to volatility, whether it is real estate or whether it is equity, all moves in cycle. There is always up and down. It helps us to avoid worry on short-term volatility and maintain liquidity as per goals. And also we can track our investments and as per our goal. Suppose markets are down today. I have been doing my SIP, but markets are down today. But I have 15 more years for my retirement. So I can always continue with my SIP and wait, because I have that timeline. It may take 1 year for, 1 year, 2 years, or 3 years for the markets to go back again. But I have that time because my retirement is 15 years away. As my retirement nears by, I need to put the money more into debt funds. So this is how we can make our investments based on our different needs, put them under different baskets. For short term needs, more debt; for long term needs, more into equity. Somebody, those who say, I don't have any goal in my mind because whatever we have accumulated is sufficient. Then the goal here will be capital appreciation or capital growth. Like I have all the money that I need for my retirement, but my goal will be to appreciate that or to increase that. There is a concept of asset allocation when we are doing goal based planning. It is an investment strategy that balance risk and reward. Suppose this is what I said. Like I decided that I have 100 rupees to invest, and I'll be putting it 25 in all the all the baskets, like debt, equity, real estate, and gold. Now equity markets have gone 30, 40, 50% high, and this my 25% has, and now an allocation of 40% or 35%. At that time I need to book some profits and shift it to other baskets. If at all the markets are down and my 25% has become 15% or 10%, then I need to invest more. It always helps us, asset allocation always helps us to buy when an asset class is at lower levels and sell when an asset class is at higher level. It has nothing to do with what the indexes are doing, how much return some funds are made. It is related only to what my investment level was. or what my buying price for the gold was, what my buying price or what my buying price for the equity MF was. So it is asset allocation is done in inversely correlated assets. Usually when equity goes up, the debts are not very high, or the gold is at stagnant position. When gold is rising, maybe the debt portion is same. So it is usually done between inversely correlated assets. If one class such as equity has significantly grown and become overweight in our portfolio, like we decided that its percentage should have been 25%, but currently it is at 35%. So we need to reduce that and put it into other baskets. And we need to reduce the exposure. This may involve selling and redeeming stocks that are underperforming compared to our equity holdings. By this, we end the session, and I hope you have got clarity on taxation, various heads of taxation, goal based investments, how we need to plan our investments as per our goal, and uh, and also on asset allocations. Thank you.
Thank you, Aarti.
Thanks a lot.
Thank you, Aarti, for this engaging and interesting and insightful session.
Thank you.
We now present you the certificate of appreciation. Thanks for the valuable insights.